$300 million in gold. That was the price of surrender. The International Monetary Fund dressed it up as a lifeline, a contract promising relief and stability. But when the fine print was read aloud in Ouagadougou, it looked less like salvation and more like shackles. For decades, Africa had been told to trade its wealth for signatures, to swap its soil and sweat for promises written in languages not its own. Many leaders accepted. Some bent under pressure. But Ibrahim Traoré stood before the cameras and refused. He called the package an economic coup, a silent overthrow carried out not with tanks, but with paperwork. In that moment, one sentence cracked open the illusion of inevitability. If a landlocked nation can say no, what does that mean for the rest of Africa? If gold can remain in African hands, what else can be reclaimed? Stay with us. This is more than a headline. It is a turning point history will not forget. Subscribe and keep watching, because what follows may change the way we read the map. $300 million in gold. That was the sum hidden inside a contract that arrived in Ouagadougou, carrying the seal of the International Monetary Fund. To the casual observer, it looked like routine paperwork. Another debt relief program, another promise of stability. But to those who read closely, it was a ransom note written in the language of finance. The IMF pitched the deal as an opportunity for Burkina Faso to stabilize its economy, unlock international credit, and assure investors the country was open for business. The Western narrative was one of partnership, a handshake in return for a lifeline. But beneath the handshake lay a fist. The clause at the center of the agreement demanded collateral, $300 million worth of gold reserves. If Burkina Faso stumbled in repayment, even due to global price shocks or regional unrest, the IMF would have the legal right to seize the gold outright. It was not a safety net. It was a trap. Worse still was the Phoenix dollar framework embedded within the deal. Advertised as innovation, it was in fact a digital leash. The proposal claimed that a blockchain-based token, anchored by Burkina Faso's gold, would modernize the economy and protect it from inflation. In truth, the Phoenix dollar would be administered not by Africans, but by Western banks and think tanks. The country's lifeblood would be drained into a system it neither designed nor controlled. Every ounce of gold mined in the future could be pledged against a currency headquartered abroad. It was colonization updated for the digital age. On paper, the contract resembled progress. In practice, it was a foreclosure waiting to happen. Buried beneath jargon lay a single reality: sovereignty traded for credit. The IMF had presented similar packages before, usually in silence, behind closed doors where leaders signed with little fanfare. This time, the daylight was different. Ibrahim Traoré did not blink. Standing before the nation, he torched the deal, branding it an economic coup. A coup carried out not with soldiers, but with signatures. His defiance was not merely technical, it was symbolic. By rejecting the contract, he rejected an entire system that had long disguised chains as lifelines. The moment reverberated. In the streets of Ouagadougou, citizens cheered. Placards declared, "Not our gold. Africa is not for sale." For a people long accustomed to watching wealth flow outward, the act of refusal was electrifying. Their gold was not just a number in a spreadsheet. It was the backbone of schools, hospitals, and industries. To surrender it was to surrender the future. Western officials were stunned. Months of careful maneuvering by Washington lobbyists, IMF experts, and financial backers linked to Donald Trump collapsed in a single sentence. What was supposed to be a quiet contract had erupted into a public spectacle. And with it came an unspoken fear. If one nation could refuse, what if others followed? This is why the 300 million was never about the number itself. Compared to Africa's vast reserves of gold, uranium, and oil, it was small. But as precedent, it was enormous. A single rejection threatened to unravel a model that had stood for decades. Debt in exchange for resources, contracts dressed as lifelines but drafted as chains. As Traoré closed the door on the deal, he opened another, a door to uncertainty. For Burkina Faso, the refusal carried both risk and promise. International credit might dry up. Pressure might intensify. But dignity had been preserved. And with it, a message had been broadcast far beyond Burkina Faso's borders. Africa could say no. The question now was not whether the IMF would return with another package. The question was far larger. If one leader can refuse the fine print, what will stop others from tearing up the script as well? The contract was not simply rejected, it was denounced. When Ibrahim Traoré stood before cameras and called the IMF proposal an economic coup, the air itself seemed to change. It was not the language of diplomacy nor the careful tone of negotiation. It was a blunt accusation, and it carried the weight of history. For decades, African leaders had signed deals dressed in polite language, knowing they bound their nations more tightly to foreign creditors. This time, the illusion was shattered in public. The moment was theater and defiance in equal measure. Traoré's words lit a spark that traveled beyond the walls of the presidential palace. Within hours, the streets of Ouagadougou were alive with chants. "Not our gold! Africa is not for sale." Placards waved in the air, painted by hand but charged with meaning. It was no longer a technical dispute over repayment schedules. It had become a movement. The crowd saw themselves not as bystanders, but as guardians of a nation's treasure. Western capitals reacted with alarm. In Washington, anonymous IMF officials briefed journalists that Traoré was reckless, endangering his country's stability. In Paris, commentators warned that Burkina Faso risked isolation if it continued down this path. But their warnings only underscored the scale of what had happened. For once, Africa had not spoken in whispers. It had roared. The shockwaves traveled quickly. In Bamako, Malian officials applauded the move, declaring on state radio that a line has been drawn in the sand. In Niamey, Nigerian leaders hinted that they too were revisiting resource contracts once thought untouchable. Within days, WhatsApp groups, community radios, and Pan-African media outlets carried the story. What seemed a single act of refusal began to look like the opening chapter of a collective revolt. Analysts on American financial networks scrambled to contain the narrative. They called it populism, warned it was unsustainable, and insisted it would deter investors. Yet even as they spoke, a note of unease crept into their voices. Because they knew what the streets had already grasped. If Burkina Faso could refuse, others might follow. And if others followed, the entire model of debt for resources could collapse. The symbolism was impossible to ignore. For generations, contracts had been signed behind closed doors, reducing African leaders to signatures beneath terms drafted elsewhere. Now, one leader had torn up the script in the daylight. The gesture was more than defiance. It was inversion. Where once Africa had been the object of negotiation, it was now the subject, setting its own terms. For ordinary citizens, the meaning was even more direct. They did not see balance sheets or debt relief. They saw their children's schools, their mothers' hospitals, their own livelihoods bound up in the reserves that foreign powers sought to seize. When Traoré said no, he was not only protecting abstract sovereignty. He was defending bread, medicine, and dignity. The reaction across the Sahel was visceral. Farmers who had long watched trucks carry gold and uranium out of their villages felt vindicated. Miners who saw wealth leave the soil without lifting their communities felt justice had spoken. Traders who feared devaluation and austerity understood that the refusal was not reckless, it was survival. The intensity of the moment could not be ignored. Crowds poured into streets, regional leaders voiced solidarity, and even the most skeptical observers admitted that something fundamental had shifted. What had been dressed up as a routine contract had exploded into a symbolic battle, the first decisive confrontation in a war for economic sovereignty. Yet the high tide of celebration masked a darker undercurrent. For if one nation could defy the IMF, what price would it pay in return? Defiance is exhilarating in the moment, but its consequences unfold slowly. For Burkina Faso, the refusal of the IMF package was not only a headline, it was a pivot that touched every layer of national life. From the economy to politics, from the daily bread of citizens to the fragile balance of state power. In the short term, the risks were obvious. International credit lines, already narrow, threatened to shrink further. Investors whispered of instability. Parisian analysts predicted isolation. Yet for ordinary Burkinabe, those warnings felt like echoes of an old script. A script that promised loans but delivered austerity. Many citizens preferred the uncertainty of self-reliance to the certainty of exploitation. Economically, the decision reshaped priorities. By rejecting collateralization of gold, the government was forced to double down on its nationalization drive. In 2025, 5 major mines had already been transferred to state ownership, redirected from the profits of foreign shareholders to the coffers of Ouagadougou. That gold represented a fifth of national GDP. Redirecting it towards schools, clinics, and salaries gave the rejection substance. It was not only a gesture, it was a redistribution. Socially, the move ignited a wave of pride. For years, citizens had endured the invisible cuts of IMF austerity, hospitals with too few doctors, schools with overcrowded classrooms, wages stretched thin. By slamming the brakes on another IMF deal, The government signaled that these sacrifices would no longer be dictated by external creditors. The message was clear. Sovereignty meant control over budgets, not just borders. Politically, Traoré's stance fortified his legitimacy. In a region where coups and counter-coups often fracture leadership, his defiance presented him not as a usurper, but as a guardian. Crowds that once viewed politics with suspicion now rallied behind him. What critics in the West dismissed as reckless nationalism, citizens embraced as dignity restored. The ripple extended beyond Burkina Faso's borders. Mali, Niger, and other Sahelian states saw an opening. If Ouagadougou could reclaim its mines and resist IMF conditions, then why not Bamako, Niamey, or Abuja? Leaders spoke cautiously, but the message was unmistakable. The refusal had created a precedent, a map of resistance that others could follow. Of course, resistance carries costs. Currency pressure loomed. Imports grew more expensive without easy access to credit. Tensions with Western partners risked sanctions or reduced aid. Yet the government framed these costs as investments in sovereignty. Better hardship on self-determined terms than prosperity bound by chains. And this is where the notion of the Ibrahim Traoré coup takes on double meaning. Western commentators saw only a military officer who had seized power and was now defying international norms. But for many Africans, the true coup was the inversion of dependency itself. It was the moment when the script of subordination was overthrown. Not a coup of soldiers, but of sovereignty. The deeper consequence lay in psychology. For decades, Africans had been told there was no alternative. The IMF was inevitable, the loans unavoidable, the terms non-negotiable. By rejecting one contract, Burkina Faso cracked the illusion of inevitability. Once a people see that refusal is possible, the chains of resignation begin to break. This shift in mindset reverberated through society. Farmers no longer measured their worth by export prices set in Paris. Miners spoke of the soil as belonging to the nation, not to distant shareholders. Students, who once saw the IMF as an invisible hand shaping their futures, began to imagine futures designed on their own soil. The challenge now was endurance. Could Burkina Faso sustain the costs of defiance long enough to reap its benefits? Could dignity translate into development before hardship eroded popular support? These questions hung over the streets of Ouagadougou as banners of celebration gave way to the routines of daily struggle. The world was watching too, for if one nation could weather the storm, it might inspire a wave. And if a wave came, the very foundation of the global financial system, debt for resources, could begin to erode. But that wave would not be decided in Washington or Paris. It would be decided in classrooms, in clinics, in markets, in the quiet calculations of ordinary Burkinabe. And so the story turned to its next chapter. How would the international community respond to this spark of defiance? When the cameras in Ouagadougou went dark, the reverberations echoed far beyond Burkina Faso's borders. In Washington, officials at the International Monetary Fund spoke in clipped tones, warning that Traoré's defiance would damage investor confidence. Some briefed journalists anonymously, painting him as reckless, even dangerous. For the IMF, this was more than a contract lost. It was a crack in the wall of credibility. Paris reacted with familiar condescension. French commentators filled the airwaves with predictions of isolation, insisting that a landlocked country rejecting international finance would soon crawl back to the table. But their certainty carried the scent of nervousness. For Paris, the real fear was contagion. If Niger revalued its uranium contracts, if Mali tightened its gold concessions, then France's energy and wealth pipelines would tremble. The European Union followed suit, voicing concern that Burkina Faso was drifting away from responsible partnerships. In Brussels, technocrats muttered about sanctions, but even they recognized that too heavy a hand might only inflame resistance. Across the Atlantic, American financial analysts labeled the decision populist theater, yet admitted that it posed a threat. Once precedent is set, replication is hard to contain. Regional organizations face their own dilemmas. The African Union called for dialogue, cautious not to appear hostile to a member state asserting sovereignty. ECOWAS, once quick to pressure military governments, spoke more softly, aware that public opinion across West Africa was shifting. To condemn Burkina Faso outright would be to risk alienating populations who increasingly see defiance as dignity. What made the episode unique was not only the defiance itself, but the solidarity it sparked. Within days, Mali applauded openly. Niger signaled reconsideration of its contracts, and whispers spread as far as Abuja. Pan-African media reframed the story not as isolation, but as a Burkina Faso revolution. A rejection of the old script where African wealth is mortgaged for Western approval. Diplomatic cables reflected the unease. Western embassies worried that the Ouagadougou effect could undermine decades of careful leverage. Analysts admitted that if Burkina Faso held its ground, others might no longer view IMF programs as inevitable. The risk was not contagion of instability, but contagion of sovereignty. And so the international stage became a theater of contrasts. Western voices condemned, warned, and cajoled. African voices from Bamako to Niamey spoke of inspiration. The clash was not simply over a contract. It was over the future balance of power between a continent long told to comply and a continent beginning to choose. The question that lingered was simple. If Burkina Faso can walk this path, who will follow, and how far can the tide of defiance rise before the old order gives way? Defiance creates headlines, but endurance builds history. For Burkina Faso, the rejection of the IMF package was not the end of the story. It was the beginning of a crossroads. Ahead lies a landscape of risk and opportunity, isolation and independence, hardship and hope. The risks are real. Without IMF credit, imports may tighten, currency pressure may mount, and Western partners may attempt to punish Ouagadougou with sanctions. The cost of sovereignty is rarely measured in applause. It is measured in long months of adjustment, in higher prices at markets, in the slow strain on state budgets. Yet Traoré has wagered that the alternative, signing away gold and dignity, would have been costlier still. The opportunities are equally clear. With mines reclaimed and revenues redirected, Burkina Faso can begin to shape an economy that serves its own citizens first. The state-owned mining company has already taken control of 5 major gold sites, channeling wealth into schools and clinics rather than foreign stock markets. If this momentum is sustained, sovereignty will not remain a slogan. It will become bread on the table. Beyond borders, the decision strengthens regional currents already in motion. Mali's nationalization of resources, Niger's push to revalue uranium, and Nigeria's growing appetite for self-determined trade suggest a doctrine of resource sovereignty spreading across the Sahel. Shared hardship may evolve into shared strategy. Instead of negotiating contracts in isolation, Sahelian states are beginning to speak with one voice. New institutions are also rising. Afreximbank and the African Development Bank offer financing without demanding collateral in gold or uranium. The African Continental Free Trade Area promises to keep value circulating within the continent rather than bleeding outward. And discussions of a continental digital currency point to a future where Africa need not depend on the Phoenix dollar or the American greenback to trade with itself. This path will not be easy. Industrialization requires investment, and unity requires trust among nations scarred by decades of external interference. Yet the symbolism of Burkina Faso's stand is powerful. It says the soil can be tilled differently, the harvest can be kept at home, and the map of dependence can be redrawn. The road forward is not yet paved. It winds through uncertainty, risk, and resistance. But for the first time in a generation, the pen that draws it is held in African hands. And so the question remains, hanging over Ouagadougou, Bamako, Niamey, and beyond. Can this defiance grow roots deep enough to carry a continent into a future written not in contracts, but in sovereignty? What began as a contract over $300 million in gold has unfolded into something far larger, a confrontation not between signatures, but between systems. For decades, the IMF held Africa in a cycle of loans and conditions, promising relief while tightening control. Burkina Faso broke that cycle with a single word: no. Ibrahim Traoré's refusal was more than an act of resistance. It was a declaration that sovereignty is not charity, that dignity is not negotiable. By calling the IMF package an economic coup, he exposed what millions had long felt but few in power had dared to say aloud. And in that exposure, silence became chorus. Chorus became movement. The symbolism cannot be overstated. To protect gold was to protect schools and hospitals. To defend the soil was to defend the future. Citizens saw themselves not as passive recipients of aid, but as active guardians of wealth. And across the Sahel, from Bamako to Niamey, the echo grew louder. If Burkina Faso can, so can we. Western voices warn of instability, isolation, and lost investment. Yet their warnings betray their fear, not of collapse, but of contagion. Because once one nation resists, others may follow. And if others follow, the very architecture of debt for resources begins to crumble. This is why the Ibrahim Traoré coup matters, not only as a military chapter, but as an economic one. The moment when dependency itself was overthrown. This is why the rejection is seen as a Burkina Faso revolution. Not a riot in the streets, but a revolt against the inevitability of subordination. And this is why history may remember $300 million, not as a price paid, but as a chain broken. The future is uncertain. Isolation is possible. Hardship is likely. But sovereignty has a different measure of success. It is not counted in ratings or rankings. It is counted in the pride of citizens who know their wealth is their own. And so the question is left with us. If one small, landlocked nation can tear up the script, what stops the rest of Africa from writing a new one? Do not look away. The story of sovereignty is still being written. Subscribe, share, and keep walking with us. Because this turning point belongs not only to Burkina Faso, but to every voice that believes freedom is not for sale.